Afternoon, ladies and gentlemen. Welcome to day one of the pre-PDAC MIF. I don't think I have to tell all of you that, or I shouldn't have to. The title slide here pretty much says it all. Right now it's all about sentiment, and sentiment has sucked. Not to put too fine a point on it. That's just, that's how it is sometimes. Keep in mind as I go through this talk, and it's only going to partially be macro stuff. Some of it's going to be, why I picked discovery plays, and maybe a few pointers to you about picking discovery plays. And all three of the companies that I have with me happen to fit that category. But the thing with sentiment is, it's one of the hardest things to gauge. I mean, when sentiment's horrible, when it's good, but picking turning points in sentiment it's next to impossible. I don't know anybody that really has a good, reliable measure. It's one of those things the turns happen after it's happened most of the time. You were either there for the bottom or you weren't. You don't usually find out until after the fact that things are actually going to get better. Usual legal disclaimer that I put in front of my talks. Every trader right now, everybody I talk to, I have the same conversation over and over again every day for the last 3 or 4 months anyways. Basically, why does everybody hate us? And I don't think it's a matter of everybody hating us so much as everybody ignoring us. Sentiment's been terrible. I think, it's so bad that I think we are in fact pretty close to the bottom. And in fact, it's not out of the question. We've actually seen the bottom. It just won't really start moving for a little while. Usually when you come off these sort of sentiment bottoms, you got a lot of people that are frustrated, just want to get the hell out. So quite often you don't see big price moves immediately. It takes some volume and it takes some time before things really start ramping up, even if you're past the bottom. A couple of things haven't gone the right way, I guess you can say, for the commodity sector. Late last year, people were excited. Everybody else, not me. Everybody was expecting, 5, 6, 7, 14 rate cuts this year. That's obviously gone by the wayside. I was skeptical about it all the time because really the macro numbers just weren't that bad. I mean, the macro numbers in the U.S. are actually pretty good. If I was an FOMC member looking at most of the macro readings, I would not be thinking about doing a lot of rate cuts. I'm not sure I'd be thinking about doing any rate cuts, honestly. And we've moved now from the market expecting 6 or 7 to the market expecting 3. I'm not 100% sure that's even going to happen. We'll see how things unfold over the next couple of months. Interestingly enough, that change hasn't really impacted Wall Street. Wall Street's fine. It just keeps rallying. Crypto's going crazy. And that's part of the reason we've had so much difficult sentiment in this sector is just, when Wall Street's acting like a broken slot machine, and that just pays out every day. You've got crypto going crazy. It's difficult for what is, let's face it, a small sector to get attention. And right now, investors haven't been paying a lot of attention to us. Even so, and I think this is important. I mean, today's a really good example. Gold's trading fantastically today. But, I wrote this before today. Gold's actually traded extremely well when you think of all the things that have gone wrong. When you think of the moves in nominal and real rates, the fact that the competing currencies, if you will, the US dollar, the main one, really hasn't weakened, it really wouldn't be difficult with the current backdrop to make an argument for gold at, say, 1,800, 1,750. Well, gold's 2,080 right now, and it's ripping today. That tells you there's clearly demand from somewhere. I don't think the demand's from where we would normally expect it, but I'll get to that in a minute. And, rate cuts, I keep seeing numbers like this. This is the Advanced Fed GDP now. The blue chip guys, they started this quarter expecting 1% growth. The GDP now estimate isn't perfect, but it's pretty good. They basically update it continuously as macro numbers come out. Their current estimate for Q1 is 3%. We rack up 2 or 3 quarters of 3%. I don't see a lot of rate cuts coming, folks. I mean, we would have to see a bigger drop than I think we're going to get in inflation. So, we got to take rate cuts out of the equation when it comes to metal prices. If we get them, it'll be great. I think you would definitely get regardless of where gold is, regardless of where base metals for that matter are, you start seeing rate cuts, you'll see rallies in all of those metals. But for the time being, I'm just assuming those aren't going to happen. And this is another thing that's worth looking at. This came out yesterday, and this is a bit of a obscure measure for most people. PCE is the personal consumption expenditure deflator. It's basically, it comes out several weeks after CPI, but it's based on what people actually spend, the prices they actually pay. And this is a number that the FOMC pays attention to. The Fed probably pays a lot more attention to this than they do to CPI, frankly. And the readings, if you're hankering for rate cuts, the readings weren't really good news. You can see this big spike here. That's the January reading. And this is what's called the super core measure. And they take out housing, changes in housing costs, changes in energy. Those are the two most volatile parts of it. And, with Supercore doing this, and you can see it, it's not much of a bounce, but it's bounced up a little bit. Again, I don't see the Fed lining up to do a bunch of rate cuts when they got numbers like this coming out. And there's reasons to think you might see PCE go up a little in the next couple of months. So I'm not holding my breath waiting for rate cuts. I'm not convinced they're going to happen. So does that mean we're all dead? Well, apparently not based on today, since right now the gold price is actually right about here. And it's actually, when you look at everything that's stacked up against it, it's actually really impressive how well gold's traded. And a lot of that is outside of North America. We continue to see very, very strong central bank demand. Central banks have clearly decided as a group they want to keep diversifying their reserve holdings. One of the ways they do that is to buy gold. Gold demand from central banks continues to be way higher than average, record levels. In fact, it's been that way for several quarters, and it still is. The other thing you're seeing is there's a lot of retail, there's retail here, but there's a lot of retail buying, again, in China. Chinese consumers are, with good reason, I think, pretty leery about what's going on in their economy. I think they maybe don't trust the yuan as much as Beijing would like them to. So you're seeing quite heavy retail buying in China. You're not seeing it here, though. I find this chart quite interesting, and really, if you want a chart that sums up sentiment, this is it. You go back to about late 2021. This black line is the outstanding shares in the GLD ETF, and basically the GLD ETF, based on buying demand or selling demand, the number of shares outstanding gets adjusted daily, depending on buying and selling, and in turn, they adjust their gold holdings based on that. When you look at the gold price has been fine since 2021. It's up here now. It's basically been on, a jagged uptrend, but still an uptrend. GLT shareholdings are just getting decimated. They're off almost a third in the last 2 years. Basically, there's no retail interest. Now, before you say, oh my God, that's horrible, we're all going to die. From a sentiment viewpoint, this is actually, it may not look like it, but this is actually a good news chart, not a bad news chart. Because the simple truth is, gold really starts to move. Retail, hedge funds, money managers, they are not in the market. They're not positioned for a move. If they want to get positioned for a move, there's only one way to do it. They're going to have to buy. And I think that's a partial explanation for the size of the price move we're seeing today. I think somebody got caught short. That's why gold's up almost $50 right now. Somebody was on the wrong side of the market. So, in a market like this, does anything work? What works? The one thing that works, in my experience, long and painful in this sector, the one thing that works in all markets is discoveries. Discoveries are really the reason I trade these stocks. I grew up in the mining sector. Way back in the day, my late brother and I had an exploration consultancy. I did the dollars, he did the rocks. I'm a sucker for greenfields exploration and new discoveries. The thing with discoveries is if you make a truly new discovery, that's one thing that basically changes the potential market value and the valuation of a resource stock very quickly. Even in a crappy market, it'll do that. Obviously, they work better in a bull market. Everything works better in a bull market. But even in a bear market, there's room for significant gains on discoveries. This isn't a low-risk end of the sector. I don't want to give anybody any illusions. Discovery investing is hard. Most early-stage exploration plays won't work. That shouldn't really come as a shock to anybody, because if they did, gold wouldn't be $2,000 an ounce. Copper wouldn't be $4 a pound. This stuff is hard. It's not easy. It takes money. It takes skills. And yeah, it takes luck too. So one thing to keep in mind is I'm just going to kind of run through some of the things I look at when I'm picking these things. But when you're playing this end of the market, you got to think in terms of owning 5 or 10 or more stocks. A lot of them aren't going to work out, and basically what you're trying to do is, trade smart. I mean, I'm not, for my own reasons, I don't generally use stop losses, but you guys probably should. You got to set them pretty wide, because these are high volatility stocks. You can't set a stop loss 5% below where you buy it. Otherwise, you're going to get blown out of every single stock you buy. You got to be willing to accept some risk. But the idea is that, 4 or 5 or 6 stocks you lose 20 or 30% on get made up for by one that makes a discovery when you're up 500% on. That's what's worked for me over the years. It's not easy. I don't want to give anybody any illusions. And when I say discovery stocks, to me that means something fairly specific. I'm personally, because of my background, I'm kind of a sucker for greenfield exploration, new targets. I mean, I'm not a huge fan of companies, and this describes probably 80% of the companies in the sector, that go out and grab something that's been drilled by 20 guys before, and they're trying to find a few marginal ounces, or they're hoping to pull a couple of good drill holes where somebody's drilled a good hole in the past. That's fine if that's your bag, but it's not mine. I much prefer I'd rather take the higher risk road on somebody trying to make a genuinely new discovery. And, like I said, make sure you own a bunch of them. This is not a put all your eggs in one basket sort of deal. Essentially, keep in mind too that right now, because sentiment's bad, the market's extremely impatient. I've seen a bunch of companies recently that put out okay drill holes, not great, but okay, like they were proof of concept. Maybe they didn't hit the bullseye, maybe the bullseye isn't there in the case of a particular company, but the truth of the matter is, the whole idea that you make this giant discovery on the first drill hole is nice, and it happens occasionally, but that's not how it usually works. Even if if you look at very successful stories that worked out great in the last few years, a company like Great Bear that I owned all the way through, that was not a one-hole wonder. It took them a long time to figure that thing out and start honing in on the right areas, and that's normally how it is. So, and the corollary of that statement too is, with these companies, the ability to finance is obviously very important. Obviously, and I'll talk about this a little more, the right team is extremely important on a technical side, but you really want to have some good market people in the deal too, because being able to manage a market, being able to raise money, exploration is a negative cash flow business. You got to have people in the deal that know how to raise money, or that have the contacts to pull money in, because none of this stuff happens for free. So ideally, if you've got a really strong technical team married to a strong financial team, that's a great combination. Grade is king. I'm a big fan of grade, but it's not just about grade. It's got to be about scale too. The simple truth of the matter is, on some kind of a new discovery, the market has to see target scale big enough that it's got the potential to have a very large resource if things work out. It's great to have high grade, but traders are not going to chase a company that's looking for 100,000 ounces. They're looking for the deal that's looking for 3 million, 5 million, 10 million ounces, and obviously it takes 1 billion drill holes to get there, but people need to be able to visualize that kind of scale. Obviously, a strong technical team is obviously really important. It's not the only thing. I mean, lightning doesn't strike twice and 3 times and 4 times most of the time. Just because somebody hasn't had a major discovery doesn't mean they're not going to make one. But ideally what you want is a strong technical team that's got experience with the rocks they're exploring in, with the deposit type they're exploring for. And I'll point out that all three of the companies that are here, you'll see that all three of these companies have very strong technical teams, but they're very strong technical teams with specific experience in the area and the deposit type that they're looking for. Basically, I want to see multiple data sets, ideally. I mean, we're getting to the point now where, you know, basically almost everything is a blind discovery. There just aren't that many places where somebody hasn't walked over an outcrop. So a lot of the time now it's going to be geophysical, geochemical, basically, you know, probably geology and structural interpretation. It's not sticking out of the ground most of the time these days. So ideally, I want to see 3 or 4 different data sets overlapping and pointing to the, you know, they all make sense. They all hang together as, yes, these things all look like what you would see for a porphyry target. These all look like what you'd see for an epithermal system. And, you know, you want to think about what, you know, what's successful, what constitutes success with a deposit type and with an area. Quite often you'll see companies make discoveries in an area where the logistics are next to impossible, or where you can see political problems coming down the road. That doesn't mean they won't get some early success, sometimes big success, but you know, keep that in mind. If you're in an area that's just really difficult logistically or politically, you know, make sure you're taking money off the table along the way. In a good market, which we don't have, but hopefully sentiment's going to turn, we'll have a better one. If you can get this combination of strong targets, strong team, good market types, it's fairly common that you will see anticipatory buying, and you can see, you know, 50, 100% moves from a couple of months ahead of the drill program to the point where they're into the first, second drill hole. That's the ideal kind of situation to find if you can, because that allows you to take a little bit of money off the table before there's even any results out. You know, bring down your average cost, bring down your risk, live to fight another day. And by the same token, if something just isn't working out, you gotta learn to walk away from it. I mean, I tend to be, you know, it's kind of a do as I say, not as I do. I tend to be the last guy standing, the last one that gets suckered into writing a check on most of these deals. I'm usually the one they call over and over and over again, because I tend to say yes over and over again. But you know, that's probably not what you guys should do. I mean, if it feels like it's not working out, and the market's going to tell you if the target's not working, the market's going to tell you the target's not working very quickly. You know, don't be afraid to walk away from stuff and just try to hang on to some capital and live to fight another day. But I find for a lot of people, the hardest thing to do is when something is working out, being able to kind of stay the course. And again, Great Bear was a great example, because Great Bear had 4 or 5 50% plus drawdowns between the time they really started hitting and the time they got taken out. And a lot of people left that one early, and it was tempting. And it's not to say I didn't take a bit of profit along the way, but sometimes the real money in this business gets made not just by being early, but by recognizing a real discovery. You know, and you don't all have to start taking geology courses. I mean, there's lots of places you can get commentary. There's lots of places you can come to shows like this and talk to newsletter artists, talk to geologists for that matter, get a sense of how a project is going. But the ability to hang in there and keep at least some of that stock for the big win, that's really where the big money gets made in this business. It's discoveries, and that's really where the fun is and where the excitement is, and that's why I follow discovery stocks. And I'm gonna end this here, and I'm gonna introduce you to some discovery stocks.